that is where I transitioned from just being a broker to being treated as an equity partner, an investor, a developer, whatever term you want to apply.
Hello, and welcome to Mornings with Joel, commercial real estate podcast, where we focus on rising stars and established players in commercial real estate and talk to them about how they are building legacies in today's marketplace.
The Morning for Joel CRE podcast is sponsored by ImpactMask.com. That's M as in Mary, ImpactMask.com. The world's most breathable mask that has 99% efficacy, which is higher than an N95 mask, and it won't fog your glasses. Check out the science behind these incredible masks at ImpactMask.com.
Hello, we'd like to welcome everyone to the 2024 edition of Mornings with Joel CRE podcast. We're very excited today. We have a special guest, Mike Salafia, who is here with us today from Stax Real Estate. And Mike, what's happening, man? How you doing?
Joel, thanks for having me on the show. Just another beautiful day down in Miami Beach, Florida. Still happy weather, compared to everywhere else. We're pretty lucky here.
Yeah, I'm happy for you. It's one of those things where it's feast or famine. You might have hurricanes nobody else has, but then when you got some beautiful weather that nobody else has as well. So
you know it.
Absolutely. Now you split your time anyway between South Florida and New York too, right? Is that correct? Or you mainly in
Yes. I used to spend a lot more time up in New York. I'm primarily based in South Florida now. And with a lot of our recent ventures and acquisitions, I'm flying around the country all the time. Coming up, I have trips where I have to spend time in Mississippi and in the New Orleans, Louisiana market and some other markets around the Sun Belt. So always moving. But yes, if you look at how I came into the business and my come up, it's all about my New York client base for getting started in my career.
Sounds good. Well, we have that in common. I started at 45 Wall Street with U.S. Trust in the bond department back in the day, and kind of led me from there. So got those common roots from that standpoint. Good place to launch if you're going into real estate, commercial real estate. So it's a good thing.
So if you can make it in New York City, you can make it anywhere.
That's what.
See. We got to the point where I had enough client base where I could start operating remotely and I did not have to live in Manhattan the majority of the year. So that was a fantastic opportunity to get out and travel and see the world, which I did for, over a decade before going into the commercial real estate space.
Yeah. Well, that works well, and you mentioned New Orleans also. We have a few assets down there, so we might actually run into each other down there one day. So we'll see how that goes.
That would be great.
Yep, absolutely. So let me back up for a second here because I didn't officially introduce you. Mike Salafia is with Stax Real Estate. And Mike, tell us a little bit about who you are, what's your position, and just a quick soundbite, and then we'll go into a little bit of your background as to how this kind of all came together, if you don't mind.
Right. So Stax Real Estate is a platform for the sale leaseback of single tenant net leased retail assets. That's our primary focus. And from re-tenanting to ground up development, our platform generates some of the highest yields on the market. So we're almost a hybrid between a private equity shop, a brokerage, and a developer. We're kind of doing all of these in one integrated fashion.
Okay. All right. And your role at the company currently?
I'm one of the managing partner. So I'm one of the founders of the company.
Fantastic. So that's fair. So how did you get into real estate anyway? I mean, we just kind of hinted at commercial real estate, but what was your journey like? How did you kind of come to the place that you are today?
Well, I have a long family background in it, but my journey for commercial real estate happened through consulting in New York City. I had the opportunity to do these consulting projects for some major players, for some large REITs. Notably, I spent several years with Moody's Analytics, CRE, and I'm working directly with their chief economist. So you could say I learned the business from the top down, right? Coming from the finance side and then moving into the property side. So around the time where I moved to Miami, I had another business doing the digital innovation consulting. And I saw a huge opportunity to break into the commercial real estate market from the sales side. I'm very good at engineering sales funnels and driving revenue. That's primarily what I was doing in my consulting role. So I wanted to take the opportunity to do this for myself. And I really wanted to cut my teeth and learn the business from the ground up. So I got the opportunity to work with one of the top teams at Marcus and Millichap. Marcus and Millichap, I'm sure all of the audience is very familiar with. Number one commercial real estate brokerage in the United States in terms of sales volume. So I had excellent experience there, right? And I had to work my way up from the bottom, like going through their sales training program, making cold calls. And I was a rock star on all the awards for making the most calls, getting deals done the fastest, and really just started getting into it. And what I found in my business at Marcus and Millichap is that we were primarily taking an existing net lease property that someone owns, and we're getting them to allow us to sell it on the market, right? They need to sell for some reason. We'll represent them on the sale. Tremendous value there, right? And then you usually find like a 1031 exchange buyer or something who wants to buy the property. A tremendous value to what they do. But I started having these opportunities to do deals a little bit differently. Like I would find these properties. I'm like, oh, hey, we could buy this. And I'm already talking to all of these major national tenants because I'm brokering the deals and I'm getting the lease estoppel. So I started, making some friends and building my network of the national tenants. And all of a sudden I had these relationships. Now, Marcus and Millichap, they don't do anything with leasing, right? It's all about investment sales. So I'm over here working with my clients, and we're acquiring properties, we're bringing in new tenants, we're modifying the lease structure, and then they're giving them back to me as listings that I can go and sell because that was my business there as an investment sales broker. So that was very exciting. But I got to the point where I had the track record and reputation to venture out on my own. And I ended up striking some deals with some great clients. On the tenant side, it's kind of like represent them as tenants. And I had a good base of landlords and clients ready to put up the capital. So I started off just by doing simple joint venture partnerships where we'd ID the property, get like a little piece of equity in the deal. And we would usually bring in a new tenant, sign a fresh lease, and then bring it back to market and sell it for a profit.
That sounds good. And I kind of want to just kind of highlight a couple of things that you mentioned here. First of all, you talked about net lease and triple net. Just explain that for the ones that might be newer to commercial real estate. What exactly does that mean so that they can understand those terms?
Right. So when we're talking about, let's start from the top up. We're talking whatever, high level.
Okay.
When we're talking about single tenant net lease retail, I'm talking about a freestanding building with one tenant. So think about your typical CVS, Walgreens, McDonald's, Chipotle, Starbucks, every gas station, for example, right? That's typically a single tenant retail property. Now, the net lease does not have to be single tenant retail. A net lease refers to a specific type of lease. And in this type of lease, typically the tenant bears responsibilities that in a normal lease, a landlord would be responsible for. Now, in the space that we deal with, the absolute triple net lease, the landlord has zero responsibilities. The tenant has all of the responsibilities, right? So the landlord, all you're doing is buying the property and you set up your ACH, you get a direct deposit for your rent check every month, and you have that for the duration of your lease. There's nothing else for you to do. Tenants typically will even pay the property taxes.
Yep, exactly. So you see that also with Dollar Generals and, places like that, Family Dollar and whatnot. So very good.
Exactly.
Yeah. For the audience, is there such a thing as a double net?
There is.
And what would that, for an example? Just give us an example.
So for example, each net stands for a item that is basically subtracted from your operating income, right? So in the double net property, let's take Family Dollar, right? In a typical Family Dollar double net lease, the landlord is responsible for the roof and the structure of the building and the landscaping. So everything outside of that store, everything you see outside, the parking lot, that's all on the landlord. the tenant's responsible for everything else.
All right. So yeah, no, that's a very good example. And I just wanted to cover that so that, as we use these terms in the industry, people that are not in the industry that might be listening in, maybe want to get into the industry, they want to be able to understand this as well. Now, with that foundation being built, and I appreciate you sharing that, you mentioned about getting started by means of JV partnerships. How important do you think that was to your growth in the industry?
Very, very important. That is where I transitioned from just being a broker to being treated as an equity partner, an investor, a developer, whatever term you want to apply.
Okay. All right. And do you think it's important for others that are trying to kind of get rolling in this particular industry to consider that from time to time?
No. Frankly, I think it's important for everybody to understand the value that they have and that they're bringing to the table and respectfully earn their way. And I face this day to day where I'll be working with various people in the industry and they put their hand out and they say, well, this is what I want to get paid, or this is what I want for compensation on the deal. And I always explain to them, well, have you looked at the full mechanics of the deal? Do you know how much money there is for people to potentially take as profits on the deal? Because what you're asking for doesn't make any sense. So it shows that you don't fully understand. When you're ready to engage in a joint venture partnership and make that transition from broker to investor, you'll know. There won't be any question in your mind. You'll be bringing a tremendous amount of value. You'll have money behind you. You have to have skin in the game, right? Nobody gave me a handout for free ever.
Yeah. Yeah. All right. Very good point. So you mentioned about,
and you have to build up your personal equity too. I've done a lot of favors for people. I've taken low fees on deals. I've done everything I can to get a deal done and build a track record. And I've spent years doing it. And we're talking millions and millions in fees, not like, oh, I gave up 50 grand at one time. Right. So it takes a lot of hard work to get there.
All right. Well, good point. I appreciate you sharing that and elaborating on that because, what we don't want to do is give people the idea that they can just kind of walk in off the street and all of a sudden, the streets are paved with gold and everything just kind of falls in place. Or, you woke up and had a silver spoon in your mouth and everything kind of worked out.
Joel, do you know I got my first deal?
No, please tell me.
I got my first deal. I had built a database and researched all of these different property owners in a geographic area and spent months researching and calling them and trying to get these people on the phone just to talk to them, just introduce myself, tell them who I am and what I'm doing. And I had researched all of their property. So I had something valuable to discuss with them. And I was strategically reaching out to people who had some kind of value event on the horizon that I could figure out. Like if they had a CMBS loan, that's public data. So I can see when that loan maturity is reaching. If somebody's reaching loan maturity within 12 months, well, they're thinking two things. I'm going to refinance or I'm going to sell, right? So finding these people. Finally, I get somebody on the phone. They don't want to sell, but they had a lot of money. They had a very strategic business plan and they wanted to acquire a specific property in a specific area with a specific tenant. So I went through and I made a new database of every single one of those properties. It was like every Firestone in the state of Florida. I think it was one of my first ones. I did this a bunch of times. But then I had to call every single one of those owners, track them down, get them on the phone, talk to them, doing all the research, writing everything down about each property. And then finally, like it took months and months and months of business development. Finally, I find one property that meets the criteria with a seller who's willing to sell for a price that is achievable based on the financing available in capital markets. And that was my first deal. It was a tremendous amount of effort.
Well, that's the point that we need to make is that it's not something where the work doesn't have to be put in, and one good thing that people have to understand, I remember even a mentor had mentioned this to me many, many years ago, that you've got to put the work in on the front end in order to get the dividend. That's the way this actually works. It's not just going to come any other way. So appreciate you elaborating on that and how that all kind of came together for you. Makes a lot of sense. And I'm glad you put the work in because then that launched the formation of Stax Real Estate. And you mentioned a minute ago about Stax and exactly kind of what it does in a capsule, if you will. But let's go a little bit deeper. What exactly is Stax and how does it differentiate itself in the marketplace?
So Stax is, again, it's an integrated commercial real estate company, and we have a few different arms, right? So everybody knows our brokerage arm because we're out there representing buyers and sellers of properties. What they don't see publicly is behind the scenes, we have a private equity fund where we're raising our money directly. We're structuring private equity deals with other funds and creating joint ventures and other investment vehicles to get deals done. And we have our tenant relationships that we develop because typically in our business model, what we do is we find a underperforming property. It could be vacant, or maybe it has an operator that's just not doing a good job, and we know that they will give up their lease, right? So then once we target that property, we'll go out, we'll buy it, and maybe do a bridge loan, or we structure it in many different ways. But we'll go out, we'll acquire the property, but we'll acquire it with the tenant in tow as our partner, right? So the tenant's coming in and they're going to sign a lease, and then we'll take that property and we'll sell it in the marketplace as a stabilized triple net lease property. So the value that we bring is engineering these new leases, because the value of the net leased asset, it's more than just the real estate, right? In a typical real estate deal, you have your land and improvements, you have your dirt, and you have a building, right? That's a typical deal. That's one valuation. Now, once you add a 20-year triple net lease, you can also include the net present value of those 20-year lease payments on that schedule. So it's a huge value add that we bring to the table. And that really, and there's a number of other things that set us apart, but that's our approach. From a technical standpoint, we have our own proprietary underwriting software, AI-powered financial models. So that allows us to underwrite thousands of deals at scale. We can move faster than a large REIT or your typical private equity shop focused on acquisitions, where you can just move faster, underwrite the deals faster, and understand them faster. But that is for our niche. It takes a considerable amount of time to build these models. So we have them for gas station convenience. We have them for automotive. We have some medical use properties. We have for quick service restaurants. But for example, we do not have these for drugstores or supermarkets.
Is that coming in the future or just not an area of focus right now?
Let's just stay in our lane. We're really big on these smaller single tenant deals. I think this is truly our niche. We can do them at scale. We understand these properties. And I'm also a co-founder of a small convenience store chain that's getting started and seems to be growing pretty rapidly. So we're very focused on that space and integrating with these new market trends like EV adoption and AI robotics and other trends that are happening in the operations space.
Okay. All right. Sounds good. Now, I know you guys have focused, I'm not going to say exclusively, but you've had a lot of focus on gas stations. Why do you correct the gas stations? What's the appeal there?
Well, you got to look at a few things. So look at 2023. There was a tax incentive for accelerated depreciation at 80% year one. So there's a lot of tax reasons moving money into gas stations, specifically triple net lease gas station investment properties. As you know, 2023 was not a good year for anybody in commercial real estate in general, right? Like big picture. So you have to go where the money is, and where the money is where deals are being bought or sold. And those are assets that are currently being bought or sold. If you're somebody who bought a Chick-fil-A in 2020 at a 4.25 cap, well, good luck selling that now based on where interest rates are. So there's a lot of folks in the marketplace that unless they have debt coming due or some real bad reason to sell, they bought at such a low cap rate that it doesn't make sense for them to sell right now. So those guys are going to hold, right? So the typical bread and butter net lease business of selling fast food restaurants and selling drugstores, that really slowed down in a big way. And, Dollar General, for example, they're still doing a lot of new store rollouts. But look at how many players have kind of slowed down on their new store rollouts, specifically drugstores, right? That one got hit really hard. So that's really a big reason. That, and I already had a client base. Gas stations just kind of came to me. So, one of my first clients at Marks and Millichap was related to gas stations, also one of my first transactions. So I started just building a natural transaction record there. The reason I personally invest in gas stations is because for me, it's an essential infrastructure play.
Mhm.
And I have very specific criteria that I look for here in Florida and really throughout the United States. But Florida is an easy example because everybody's taken a trip here at some point. So when you look at Florida and what I'm doing here, you have to go back in time. And you go back to the 1970s, because prior to that, Florida was very underdeveloped. But if you look at all of the massive development that happened between the 70s and 80s, there's a lot of urban planning that went in, and there were specific zoning for gas stations. Okay. Now, for those areas that were developed in the 70s, they've now grown to the point where they've reached market saturation. So the big players, the 7-Elevens, the Wawas, the guys that could put a small guy like me out of business, guess what? They're already there, right? So I'm going after these gas stations. Again, they don't have to be built in the 1970s, but I'm saying it's zoning that happened decades ago. It's still there. The property's been renovated. It just looks like a normal gas station now. It's in good shape, but it's usually independently owned and operated. So I go in, I buy out the real estate, I buy out the business, and then we bring in one of our new tenants. So that could be my company, Re-Up, or it could be one of the numerous other tenants we have in our roster. But we work with all the major fuel brands, Shell, BP, Chevron. We're working with everyone. We even have 7-Eleven deals going.
Gotcha. Yeah, I was actually going to ask you about that. Are we going to start seeing Stax Real Estate gas stations around town, or is that just going to be the parent company?
No, it's
Put a flag-
they're two very, very distinct companies.
Okay.
And two completely separate management teams. I just happen to be a managing partner in both companies because of what I bring to the table. And the convenience store operations company really happened organically. It happened out of a demand from my clients because I did over 160 gas station deals last year, right? So I ended up having all of these smaller groups of, this team can do task 1 through 3, this team does task 4 through 5. And I just brought everybody together under one corporate entity and set up this new company to operate the stores. But it was really out of the demand for the landlord saying, well, we know we can trust you. We know you know how to execute on this. Can you please just manage all these people and manage all these stores at the executive level? I'm obviously not going and working at a convenience store. I have people work for me and do that kind of thing. But yeah, that's how it's been going. So the store name is called Re-Up, 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 refuel, recharge. And we just want to make like nice, clean, modern gas stations really for the millennials and the new generations. When you think of a gas station, what do you think of? Like kind of like dirty, I wash my hands after. We don't want that. We want the opposite feeling. So we've created a very fresh brand. We're focused on bringing more healthy snack options and healthy food options into our convenience stores. We're bringing more innovative products, like focusing, for example, have you seen wrap snacks?
No.
They're potato chips. They're so cool. They're wrap snacks and they have all your favorite wrappers on the potato chips, and the potato chips are good and they have cool flavors, right? So we're focusing on selling wrap snacks instead of selling Lay's potato chips, like that kind of thing, differentiating ourselves. The other big thing we bring to the table is because of the relationships with some of my partners, we're engaging in AI robotics for food and beverage. So this is a big emerging trend in the QSR space. For example, the founder of Chipotle in his latest venture, he's heavily utilizing AI robotics to kind of create his new concept that only requires 3 full-time employees to operate a shift because the robotics do some of the other heavy lifting. Now, the robotics by no means replaces the human. It just takes out some of the very mundane tasks, right? So the main robotics product that we're working on now is called the Wingman. That's what we call it. And it's our fryer robot machine, right? So we have our design partners in Chicago, and it's manufactured with parts from China and assembled in India and then finished out in Chicago. And it's a very complicated international business. But the bottom line is we're engineering these machines, and we have existing prototypes. We're just working on making it smaller and more compact for convenience stores. But the machine operates your fryer, right? So typically there's two things that are going into the fryer. It's French fries and fried chicken. Both are frozen. So the AI robot, all it's doing is taking a bag of French fries out of a freezer, pouring it into a fryer, lifting up the fryer, pouring that into a slide that goes into a paper box. And then it's up to the human to do the human's job, which is provide customer service, right? So the human is now taking food and putting it out in a little display where it stays warm, and then serving it to the people when they say, I want the French fries. Can you please give me one order? Sure, sir, I'll take it out and bring it to you. It's just a nicer experience overall. And this is very early stage. This is tech. We're not overly investing. We're keeping it very cautious, but I think we're going to nail it on this model for the fryer. And that's going to start going into all of our stores and replacing where we usually had like a crispy crunchy, or sometimes we just have some unbranded food service. We're going to start replacing it with that format. And we have another machine that does the coffee bar, right? Like imagine a barista, but it's just a robotic arm that moves around and does all the stuff. Can make a perfect cup every time. So we've got a few of them that we're going to start demoing and trying out. And we'll see where the evolution of that goes. But that's a big thing that sets us apart.
All right. Sounds good. Sounds good. So the re-up stores, are they just in Florida now, or are they in other markets around the country?
Our stores are in Florida and then in Mississippi. Those are our two markets right now. And then we're strategically expanding throughout the Sun Belt into Louisiana and making a few other acquisitions as well.
Gotcha. So just to be clear, is this something that you would say competes with the racetrack and QTs and Wawas of the world, or is it, just an upgrade to the standard Shell gas station that you see on the corner?
I would say it's more of an upgrade to your corner gas station, right? We're by no means focused on doing these large format stations where we have 2 acres and a 5,000 square foot convenience store with several businesses operating. I'm sure we'll get there someday. But look, all of these guys who you just mentioned, like the Quick Stop guys, for example, they all started the same way as us with the smaller formats, and then, had their capital opportunities to grow and do the ground up development. The thing is that takes a very long time, and you're not going to scale from 1 to 100 doing that, right? It would take you years and years and years. To use our model where we're breathing new life into existing stations. And again, the key thing for me is the competition, right? If I go into a new build market, it could be beautiful. It could have subdivisions, everything else, but there needs to be restrictions from competition coming in across the street and eating into my margin. So by going after these second generation corner stores, usually the competition's already there. That's what I look for. There's already the 7-Eleven down the street, right? This gas station's already surviving. All I need to do is take it over, re-image the property, make it nice, repave the driveway, paint the building. We're going to rip up the floors, put in new ceilings, like make it nice and modern, better lighting, new bathrooms, very clean. Everything needs to be clean, right?
Yep.
And then we do that, and we can increase revenue easily by 20% based on what it was doing before. And we have a good operations model, right? Where for every one of our stores, a lot of my business partners are Indian. So we have one person in India on the cameras watching the store at all times. And they're also watching the computer system and seeing all the activities. So if we catch too many void transactions in a row, for example, someone gets on the phone and calls the store and says, what's going on? right? So that dramatically increases shrinkage to a very low level.
All right. Very good point. I know, as you probably know, I've been on the finance side for many years. And one of the things that we found with gas stations was that the profit wasn't so much in the gas, but it was in the stuff in the store. For the that's where the margins were. But then you had a lot of stores that were throwing out stuff because they couldn't get people in the store. So how do you kind of work around that? And you may have answered it, but is there anything that you think we're missing as to how do you make that transition? Because that seems like an area where a lot of people struggle, is actually getting people in the store to consume those other beverages and things that are there.
Exactly. And that's a big difference. If you brand your store as re-up and you get our new re-imaging, our new interior, it makes the stores very attractive for people to walk into. So for example, on one of the stores we're setting up in Florida, it has a wall on the side that has no windows, but the wall has very good exposure to the street. So we're printing this big vinyl graphic that's exciting and unexpected and artistic to make it more comfortable. Also, in the windows, we keep the windows open so you can see into the store from the outside. Whereas in your typical store, they're covered in posters and weird neon signs. You don't know what's going on inside. It's a mess. Everything is clean and transparent.
All right. Makes sense. Now, there was a question that came up kind of in our, setup to this call, and it was about using data to maximize asset value. How are you guys using data to maximize asset value? You mentioned about your AI platform. Was anything beyond that, or was that pretty much what you were thinking about in that regard? And how you?
Well, I mean, that's what we use. But if we want to talk about in general, right, for the audience, what do we mean when we talk about analyzing data to maximize asset value? It's all about creating intelligent analytics, right? Like getting information that will help us make better investment decisions.
Right.
That's what we're looking to achieve. So how do we get there? What are we talking about with all this? Well, let's just use Stax, for example, right? Say I buy a gas station. The gas station is vacant and I have no historical sales because the store's been closed for a year. So I don't know how many gallons it's selling per month because it's closed. Maybe I know how many gallons it sold 2 years ago before it closed, but how do you know how much you're going to sell? And how do you know how much you're going to sell inside of the convenience store, right? So take like 7-Elevens and Walmart. They do the same thing. They have all of this sales data and then they match their other comparable store sales data to other markets that have similar demographic profiles. We're doing the same thing. It's predictive analytics. I really learned this from working with the large national tenants and understanding how their site selection process works. So at Stax, for example, we have our own proprietary database with store data from tons of sources, tons and tons of sources, right? And we're actually pulling it from multiple sources and strategically sharing it with other partners to help them. Like, okay, you have 100 stores, you give me all of your sales data. All I need to know is the main sales data and the demographics and have that correlation. I don't need a fine amount of details about your business specifically. It's very top level data. You could almost call it metadata in a way. And when we can make these correlations, that helps us understand how much rent that property can potentially bear, right? Because for us as the investors, in general, it's if we can put a higher rent and keep the cap rate low, then we make more money, right? For the tenant, typically they want to keep the rent as low as possible. The less rent they have to pay, the more money they can make in the business.
Sure.
For the investor, we also want to keep rent low because then we know that the tenant's going to stay and it keeps rent the risk low. So there's all of these factors that come into play, but the goal is to create something that's stable and secure. And what we've seen when things go wrong, it's typically for the typical reason is because the rent is too high, right? Somebody agreed to a rent that is way higher than they can bear for operating the store. And all of a sudden, they're not making enough money operating the store, or they're breaking even, or maybe they're even taking a loss, and it's not a good deal anymore.
Yeah.
Right. And that's the last thing you want is for your tenant to say, I'm not making any money here. I'm not paying you rent, default, and we're going to settle this in court. That's your worst case scenario that you want to avoid. And that's really what we're doing with the analytics, predicting what the rent should actually be beyond just market comps, because market comps can very much be misleading.
Yeah. Gotcha. Okay. No, that makes good sense from that standpoint. One other thing I wanted to kind of give you an opportunity to highlight. Could you walk us through a successful triple net lease transaction that you did? Because you're doing triple net lease, but you're also doing sale leasebacks and different things in that regard as well, from what I understand. So, is there a case study that you can think of that you might want to share with us?
Let me just do it with round numbers to make things easier, if that's okay. But I don't have the exacts in front of me here. But for example, we acquired a gas station in Winter Park, Florida, right? And we acquired it for, let's say, I think we acquired it for about $2 million for that gas station.
Mhm.
We then brought in the tenant and signed the lease. So now, and we took out a bridge loan to close on the property. So we're probably paying about 10% interest on the bridge loan, but with the price that we bought the property and the rent, we were able to get that secured at about a 12% cap rate for us. So we don't have negative leverage. Our cash on cash isn't great, but we've got the deal bridged. Okay. So now we took this unstabilized gas station that was struggling and we've acquired the property. Okay. Next thing, we're going to put some money into it, spend some CapEx, clean it up, make it bright and shiny, then send the photographers out there. Okay. And then once we have the photos, we've already have our marketing package done. We insert the photos into the marketing package. And now we have an asset that has a market valuation of a 6% cap rate, right, for an asking price. So we brought that property to market and I believe it traded at about a 6.5% cap rate.
So, very simple model. I mean, that's basic fundamental stuff, you know?
Yeah.
Yeah. Within these, there, basically.
Right. Now, behind the scenes, there might be maybe we're working with a private equity fund and they've structured tax credits and now they're selling the tax credits as part of their investment package. And there's a deal with the fuel supply company and there's deals with vendors and a lot of other things that happen behind the scenes. But that's the fundamental for the real estate component. And that's what is happening at Stax Real Estate.
Yeah. Yeah. Okay. No, that's a real good example. What do you see as regards the trends in the automotive and real restaurant industries? What do you see going forward as regards to market trends in that space?
Again, we talked about AI robotics. I mean, I think it's very early stage for that, but I think that's going to be one of the biggest trends. And, if you're interested, look at kind of the prototypes that are getting put out by the various operators. Look at, I saw something from Taco Bell, for example, with like a 2-floor format where the drive-through actually gets like pushed down through a tunnel. Just getting more creative and more efficient to kind of remove the burden of I think one of the biggest challenge we face, especially as retail operators in the United States, is dealing with getting reliable people to do the jobs that are at the lower wages, right? So getting a guy to run the fryer machine, it's harder than you would think. It's easier for me to hire an MBA out of a good college for a full-time job than it is for me to get a guy to do the fryer machine at minimum wage. There's a big shortage in that labor market. So I think taking away some of these mundane jobs that people just don't want to do, right? And we're getting it done through these robotic systems at a reasonable cost. I mean, obviously it doesn't work. The cost is super high. But the way I'm doing them is at a reasonable cost where I can see a return in a reasonable horizon based on financing available. So just connecting all of those dots, right? And then that frees you up as the operator to spend more focus on customer service.
Mm-hmm.
And customer service makes a really big difference for each individual business. It doesn't matter if you're a restaurant or a convenience store. If people come in and they're greeted with a smile and everybody's happy, you're going to have a better business than when you have, a bunch of angry teenagers who feel like they shouldn't be there. They're being underpaid.
Yeah, very true. You see that a lot in, especially in the fast food industry.
Right.
You hate your job that has nothing to do with me. I mean, just give me my food, right? So,
Right. It's just restructuring labor, re-incentivizing your people, making people feel like partners. I think Chipotle does a really good job with this.
yeah,
in general.
absolutely.
Drive-throughs are huge, Joel. And then another trend we're seeing on the real estate side, and this has been happening for years, it's nothing new, but everybody should think about it. Since we're talking about single tenant net lease, what about these new multi-tenant net lease strips we see popping up everywhere, right? You see like a Starbucks and an Aspen Dental, for example. And developers like these because they fit, you can take a standalone parcel where it's maybe too big for just Starbucks by itself, but it's too small for you to build a shopping center. If there's other retailers nearby, then you can do that 2-unit strip. We've seen some of them 3, 4, 5-unit strips. They're all triple net. It's a really easy rent roll to manage. And especially when you have them with two, it's kind of like a 2-for-1 deal. You just have those 2 leases. They're all triple net. So I think that's a big trend, and that's something we'll see more and more, especially in areas that are already developed and maybe they're being redeveloped, right? So you have a specific size lot. You can't just demolish 10 acres and build a shopping center. You've got to work around with what you have. So that's a really good strategy for developers.
Yeah, good point. Appreciate you bringing that out. I think a lot of people realize that during the recession, if you're doing retail, you need to have retail that is unamazonable, if that's a word. In other words, you can't get gas through Amazon, right? You can't buy your gasoline through Amazon. So you can't get your hair done through Amazon, right? So you have these other entities that are at the gas station, perhaps in a strip center or contiguous to it, and they're able to provide value to the tenant base or the clients in the area. So a very, very good thing to take a look at in case that.
It also going on offense against Amazon, is a big trend. So integrating DoorDash into your store, integrating Uber Eats into your store, and making sure you have a good pickup program for those people at the store level, so they're not creating issues with your traffic flow. That's been a huge trend. Literally just setting up, where's the pickup station going to work? How am I verifying orders for each store? Think about how much work there is because of how many stores there are that have to do that. That's big. So we're integrating with all the delivery services at the re-up stores. And in some markets, there's not that many other people offering these delivery services. So we come up pretty high on the app.
Interestingly enough, I ran across something the other day where a gas station that had some extra space actually put in a food kitchen and incorporated that in the model as well, a commercial kitchen where, a variety of restaurants can provide their food for delivery. And what it did was it drew a lot of people to the gas station there because, you're picking up food and you need gas and it's right there, why not? So maybe
we do it more often than not.
Yeah.
We do it more often than not. And the last deal we just closed up in Winter Garden, we have a taco shop inside the gas station.
Okay. Yeah, so those type of things can work. I do want to talk about 2 other things before we wrap up. We're kind of coming up on time here, but I want to, number one, before we wrap up, I'm going to give you some words or time to say what you want to say to investors that you might want to talk to about investing in what you're doing. And I do want to talk also about the impact of EV in this particular space, because you're focused on gas stations and a lot of people are saying that gas stations are going away. So I know I would think you have a strategy related to how you're going to mitigate that as well if gas station sales, goes down compared to EVs increasing. What would you say to that?
So number one, we're just modeling it on our business plans and financial models. We're assuming that fuel sales could decline within X amount of years. And it's going to depend on the market. Okay. In these stores we're doing in Mississippi, the fuel, it's not going to just transition to EV overnight.
Right.
That's just look around. It's not going to happen. You got trucks everywhere. People need pickup trucks. I'm sure they can have EV pickup trucks, but that's a big hurdle to get that market to adopt. When you go to South Florida, for example, EV is expanding. But the thing is, the population keeps expanding. So the gas sales continue to go up every year. So it's confusing But the bottom line is we're underwriting these deals. So if there was a federal ban on gas tomorrow, we can still be profitable, right? And we're also adding EV charging stations to our property. So for every time we open a new store, right, we work with whoever our EV partner is for that market. They'll run an independent analysis. And if they say like, okay, there's a good rate of EVs here, then we get approval to put up chargers. We work with the local utility provider to make sure we have the electrical infrastructure. Boom, 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 get the chargers in there. Now, what we're also doing on these chargers is out of home digital advertising.
Okay.
And this is a big part where like my tech background comes into play. So now I've got another business putting these like mini billboards and displays that run on the EV chargers, which is great. And just also thinking about future fuels. EV is not the only alternative energy in the game. There's a lot of talks about hydrogen fuel systems coming into play in the automotive industry soon. So I think we're going to see a continued evolution. And the key thing that we're doing is just modernizing the convenience store experience for this new customer base. If you're an EV guy and you need to spend 15 minutes charging up, well, what if you know, in your mind, you're like, oh, well, I can always go to a re-up. Like, it's kind of like how I think, like anywhere I am, I can always go into a Starbucks, get a decent cup of coffee, use the restroom. It's going to be clean and I can be out of there. Same thing. Like, oh, where can I charge really quick? And everyone's like, oh, well, you know, they'll have chargers in the mall and in there. Well, do I really want to drive all the way into the mall parking lot? Right. If I pull over really quick, I'll go into the re-up. They have free Wi-Fi. I have to download something from my phone really quick, or, you know, I just want to sit outside. We're doing a lot of these in Florida. So we have outdoor cafe seating, for example. It's making a really nice experience and putting some more interactive features into the convenience stores. So that way, yes, there's the fast convenience shopping, but maybe there's a few things where you can just stand there and look for a moment or two. Remember the magazine rack?
Yeah.
Right? Like those kind of disappeared.
Yep.
So certain things like that, or, you know, you can buy a cup of coffee at a very good price, sit down outside, finish your cup of coffee, and by the time you're done, your car is charged. You can go.
Sounds good. Sounds good. All right. Well, fantastic. So as we wrap up here, certainly appreciate what you shared with us today and how you've differentiated yourself in the market. What would you want investors to know, and what opportunities are there to participate in Stax if someone chose to do so?
Yeah, absolutely. So if you're an investor listening, we do have our private equity fund open, Stax Ventures Fund, and that would offer accredited investors the opportunity to invest with us. You basically commit your money to the fund, and then you get to participate in our proprietary investment strategies. That is the absolute best way to get involved. If you're interested in reaching out, we are very easy to find at staxre.com. That's STAXRE.com. Or just type in Stax Real Estate into Google, search my name in Google, Michael Salafia, and we'll come right up. Very easy to find. We're on all the social media, have all the websites. That would be the best way for investors to get involved. And if anybody would like to have a more specific discussion regarding selling your gas station or making acquisitions for yourself, the various tax strategies and value add strategies that we're working on, or AI robotics, you know, we're open for those conversations as well.
Okay. All right. Fantastic. Well, Mike, it's been very insightful. I like that we had a chance to come together here, because what you're doing is not what we normally talk about on the podcast. I remember you mentioning that, you know, you're a listener of the show. We certainly appreciate that. And one thing I will say is that this really will stand apart from a lot of the other content we have on the show. So that's really appreciative. We appreciate it. And we know that our audience will get a lot of value out of it. So any final words you want to give us as we sign off for today?
No, I just appreciate everybody for listening. I hope everybody received some value from the episode. And again, don't hesitate to reach out to Stax Real Estate, STAX Real Estate. And we look forward to hearing from you.
All right. Fantastic. Well, again, this has been the Mornings with Joel CRE podcast. We certainly appreciate having our special guest, Mike Salafia, here today. And we look forward to catching up with you guys again. Mike, thanks so much for being here, and enjoy that beautiful weather down in South Florida.
Thanks, Joel.